As successful executives, we understand the importance of strategic decision making in both business and personal finance. Yet, one area that even the most seasoned professionals sometimes overlook is tax planning, specifically lifetime tax planning versus simply filing an annual tax return. Hi, I'm Will Hoffman, founder and president of Hoffman Wealth Management, where we specialize in working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while creating the life that they desire. We all know the drill. Every year, come tax season, we gather our documents, get our info to our accountants, they check the numbers and file a return. Sure, getting that task out of the way feels like a huge win. But here's the thing. A year-to-year tax return is merely the tip of the iceberg. It's reactive, it's tactical, but isn't really strategic. While your annual tax return focuses on one snapshot in time, it's a history book for the previous year for you and your family financially. Lifetime tax planning takes a holistic, long-term approach. It's the difference between managing short-term obstacles and ensuring that, over the course of your career and into retirement, you're optimizing every financial decision to minimize taxes and grow your wealth. Let's look at it this way. Imagine your wealth accumulation like you're building a skyscraper. Would you plan just one floor at a time? Of course not. You'd plan the entire structure from foundation to rooftop, considering the efficiency of the entire building to make sure you're getting the most from the process. The same should apply to your finances. Lifetime tax planning spans your entire financial journey, from your high-earning years as an executive to retirement, and even estate planning for the next generation. It's about strategic moves that can affect your taxes in significant ways, such as maximizing contributions to retirement accounts like 401ks and IRAs, minimizing capital gains tax through investment timing and charitable giving, utilizing Roth conversions at key points in your life, taking advantage of tax-efficient charitable giving, and leveraging trusts and other estate planning tools to reduce future tax burdens. One key area where lifetime tax planning really shines is in maximizing the use of your retirement accounts. For high-income earners, the ability to contribute the maximum to tax-deferred accounts like a 401k or a traditional IRA can help reduce your taxable income during your peak earning years. But there's more. Strategic use of Roth IRAs and Roth conversions, where you pay taxes on your retirement savings now and enjoy tax-free withdrawals later, can be a game changer. If you plan properly, you can avoid huge tax liabilities in retirement when you might otherwise be in a higher tax bracket. By taking advantage of tax-free growth opportunities and strategically planning withdrawals, you can preserve your wealth and make sure your money lasts as long as you do. Now, for many executives, stock-based compensation like restricted stock units or RSUs and stock options makes up a significant portion of total compensation. But these forms of income can lead to substantial tax liabilities if not handled strategically. RSUs, for example, are typically taxed as ordinary income when they vest, and that could push you into a higher tax bracket, especially if you don't plan ahead. Similarly, with stock options, exercising them at the wrong time, especially during a high-income year, can lead to significant tax burdens. With lifetime tax planning, you can approach your stock compensation strategically. For instance, spreading out the vesting or exercising of stock options over multiple years can help you minimize the tax impact by keeping you in lower tax brackets. You can also leverage 83B elections on early stock grants or consider deferring some income to retirement when your tax rate might be lower. The timing of these stock-related decisions can make a massive difference in how much of your compensation you actually get to keep. When combined with strategies like Roth conversions or charitable giving, the tax savings over your lifetime can be substantial. But there's a critical aspect of lifetime tax planning that many executives overlook, and that's the widow's penalty. When a spouse passes away, their surviving spouse's tax situation can change dramatically. Suddenly, they're taxed as a single filer, which often means higher tax rates on the same amount of income. Then this can happen just when they're relying most on retirement income and assets. Without proper planning, the widow's penalty can erode a significant portion of the surviving spouse's income, leaving them with far less in the long run. However, with a well-executed lifetime tax plan, you can minimize this impact. Strategies like accelerating income or Roth conversions before one spouse passes, or even creating trusts and other estate planning structures, can help mitigate this penalty. The goal is to ensure that your family's financial future is protected no matter what life brings. Think of it as a chess game. Filing a tax return each year is like moving one piece at a time. But lifetime tax planning is seeing the whole board, planning several moves ahead, and positioning yourself for long-term success. Now, don't get me wrong. Filing your taxes accurately and on time each year is very important. But if you're not considering the bigger picture, you could be leaving a lot of money on the table. And for high-income earners, even a few percentage points in tax savings could mean the difference between retiring comfortably and leaving a meaningful legacy. When you start thinking in terms of decades, not just fiscal years, you gain greater control over your financial future. That's the power of lifetime tax planning. So, as you review this year's tax return, ask yourself this: am I looking ahead? Am I positioning myself for long-term financial success? If the answer is no, it's time to think differently, because lifetime tax planning isn't just for the ultra-wealthy. It's for every executive looking to make smarter, more impactful financial decisions.